from Abuja.
Hello, thank you for being a part of our show. We appreciate you. I'm Magnus Kpakol, and this is Magnus Kpakol GVA, Global Views Africa. As always, it's all about how we can raise the level of living. That's what it's all about. In view today, the impact of falling commodity prices on emerging market economies. We have important comments from a recent seminar organized by the World Bank and the IMF in Washington, D.C. earlier this year. As we will see, the impact has been good and bad, depending on if you primarily sell or buy commodities as a country. But before that, in our hidden economics, street hawking as an economic indicator. Now, up next, we briefly discuss diversification, export promotion, and economic growth in our quick view. That's coming right up. It is becoming even more critical for sub-Saharan Africa to speed its export diversification if we're to push back the ongoing effects of declining commodity prices. Mineral, especially crude oil export revenues, have dropped well below many previous psychological barriers, as the United States, the largest economy in the world, continues to search for ways of reducing dependency on energy imports. For example, in 2012, Sub-Saharan Africa's exports to the United States decreased 33.2%, about $24.7 billion, to $49.6 billion from 2011. To be dynamic, Sub-Saharan African countries would need to greatly diversify their exports. Therefore, for non-oil export promotion and economic diversification, increased attention would have to be paid to community economic competitiveness, with emphasis on the development of physical and social infrastructure, including investments in roads and energy infrastructure, education, and health services. In Nigeria, the development of capital-intensive industries that utilize the nation's competitive advantage in hydrocarbon resources would be imperative. These industries would include fertilizer and petrochemicals to produce products including detergents, adhesives, plastics, fibers, lubricants, and gels. Of course, given other endowments in the country, potential exportables would include agricultural and food products, cement, construction materials, electrical products, textiles, clothing, furniture, and household items. Still in view, the impact of falling commodity prices on emerging market economies. But up next in our hidden economics, street hawking as an economic indicator. Street hawkers. Some people call them street executives. Well, you see them literally everywhere in Africa. They are now an integral part of urban economies around the world, and particularly in sub-Saharan Africa. Indeed, street hawking as an occupation has existed for hundreds of years and is considered a cornerstone for the historical and cultural heritage of many cities. As peddlers, or shall we call them distributors of affordable goods and services, they provide consumers with convenient and accessible retail options and have become a vital part of the social and economic life of our cities. Sometimes, as a very visible segment of the urban informal economy, it is indisputable that there are thousands of street hawkers in most big cities of the developing world. For example, street vendors account for about 16.4% of total employment in Bamako, Mali, and as much as 20% in Lomé, Togo. As a share of total informal employment, Street traders generally account for between 15 to 25% in African cities, 10 to 15% in Asian cities, and 5 to 10% in Latin American cities. Now, how is street hawking an economic indicator? How does it reflect economic performance? Here is it. When the number of street hawkers increases, it implies that the economy is doing well, and therefore that more people can afford the merchandise being sold. However, the quality of the economy is not good enough to create better jobs for these individuals who must now turn to very low-paying street hawking. Therefore, where the country's macroeconomy is good, but people are flooding the hawking industry, it implies that income inequality is growing and inclusive growth is eluding us. Our hidden economics for you. The ongoing sharp decline in commodity prices has inflicted a heavy toll on many African and other emerging market countries. Recently, the IMF and the World Bank had a seminar on the subject in Washington, D.C. With Javier Blas of Bloomberg News moderating. The seminar looked into the differential impacts of falling commodity prices on emerging market economies. Other featured speakers included David Lipton, first managing director at the IMF, and Anthony Venables, who teaches economics at University of Oxford. We'll now pick up with Javier Blas in the discussions.
And the drop in commodity prices has been widespread. We have iron ore, for example, is actually one of the commodities. This is the percentage change in the price of commodities over the last 2 years. And I have used monthly average to try to avoid some of the peaks and smooth a bit the numbers. But you see almost 60% drop for iron ore, 48% for crude oil. Cotton is down 26%. Copper is down 22%. And there are a few commodities that they are up. So there are some good news for some producers. The price of bananas, for example, is up 11% over the last 2 years. And the price of tea is up 3%. And I was told by the minister from Colombia that coffee prices are doing also all right. And actually it's true that Starbucks just keeps asking me exactly the same money regardless of what the commodity is doing.
These are certainly salient points from Javier Blas that countries like Nigeria and others in sub-Saharan Africa should take note of. Let's continue with Mr. Blas as he rounds up his initial remarks.
So you see, we have a widespread drop in commodity prices, with some commodities actually falling more than 50%, and those are key commodities. Iron ore, oil, those are two of the most important commodities for the global economy.
We will now hear from David Lipton as he provides an IMF perspective.
Well, we think on balance that the decline in oil prices, the decline in other commodity prices is supportive of the global economy. You can read, we've written quite a bit about this in the World Economic Outlook paper that's just come out, so you can look in and see in detail some of the things that I'll be talking about. When we talk about oil prices, of course, we have to ask really what's behind this. Our assessment is that the majority of what's happened has been because of increases and surprise increases in the supply of oil. And that leads us to believe that the impact may be somewhat lasting and not simply go away as the global recovery takes hold and demand recovers. The reason that we think that the impact is positive is we recognize that, of course, there are winners and losers. People gain and in essence, their incomes, their purchasing power is higher when oil prices go down. So the oil importing countries gain, the oil exporting countries lose. But it doesn't simply wash out because for two reasons. One, we think that those whose oil prices go down tend to spend more than those whose oil prices go down tend to contract their spending. But also there's a broad effect that whether we're talking about other commodities or many of the other commodities or oil, that these are used as an input to production, and so costs are lower, and that means that manufacturing or services that use oil or other commodities see higher profitability, can pay higher wages, may invest more, and that effect also matters. So on balance, we think that the impact on the global economy, other things equal, is somewhere between 0.5% and 1% increase in global GDP. It's not clear exactly how persistent this will be, how long it will be. And I would add that it's important to acknowledge that there are benefits besides growth benefits. If you think about it, when the oil price goes down, consumers who face lower prices may spend more, or they may save the difference. And in doing so, their household balance sheet is somewhat better. Governments may or may not pass, governments where prices are controlled or where there are subsidies may one way or another not pass through the price decline. And so government fiscal positions may improve. In fact, we think it's quite a good time for governments that have provided energy subsidies to take the opportunity to cut back on those subsidies and improve their fiscal situations. So there are other senses in which even if the oil price decline doesn't pass through to growth, that it's beneficial. Now, on the other side, of course, there are countries, and many are here at our meetings talking about many countries that suffer from these declines, either seeing their industries, their oil industries less profitable, their oil investments less profitable, their government positions based on revenues from the oil industry being hurt. And in those cases, we've had a good discussion this week, and I think it's something that will continue. And we have representatives here on the panel who are in this situation about how you respond, what the policy response ought to be. We can have some more discussion about that as this goes on. I would just add one last piece, which is that apart from the price declines to date and the macroeconomic effects, we also have to be attuned to the risk that there are special stresses that may hit certain companies, certain sectors, certain financial institutions if they have financial exposures that are based on their earlier expectations about oil prices, if they've invested a lot, if they've borrowed a lot to be in the oil business. Combining this effect, the oil price decline, with other things going on in the world, the dollar's appreciating, the euro and the yen are depreciating. Some companies may not only have their principal export price going down, but they may have borrowed in dollars and find that the servicing of the debt's harder to do. And so there may be as well risks that we all need to keep an eye on.
Professor Anthony Venables is an expert on a range of issues, including commodity prices.
There are sort of choices here to be made. The accounting identity is that if your foreign exchange earnings from oil have gone down, then you better either cut imports or raise exports of something else. But, it could be either. Maybe you cut your imports by shrinking your economy, right? I mean, that's one way to get that equation back into balance, but not one that you want to do. Another one is that you import competing industries grow to reduce imports. Okay, maybe, but I think we would all want to be here saying, well, yeah, let's try and use this as an opportunity to grow export sectors, grow new export sectors. But my point here is there are alternatives, there are choices to get that export growth and export in other sectors. I think will be difficult. It will require that price signals come through, the exchange rate appreciation and depreciations, real depreciations. It will require that the economy is flexible, and it'll require that investors in those sectors think those things are going to last. If the government has made some reforms, but they might be reversed, or if the exchange rate is going to appreciate again tomorrow, you're not going to get the investment in those sectors. So there are opportunities here for growing these other sectors. As I said, in the balance of payments accounting, other things will have to change, but it could go in different directions. So making sure it's the export growth is going to be important. A fact on that, historically, looking back, on average, it's been the case that an extra $1 of resource revenues, or foreign exchange from resources, has basically sucked in about 25 cents of imports and crowded out about 75 cents of exports. So if you think it's symmetric, if you think it's reversible, I guess that's good news. So the exports will, might bounce back, but there are choices there. It's going to be hard. Well, one other long-term thing I want to briefly say. I think at this time, it's a very good time to think about the systematic errors that some countries have made in handling resource revenues. Some countries learn from mistakes, other countries don't learn from mistakes and go on repeating them. But if you're going to learn from mistakes, it's a very, very good time to do it is right after the shock. It's at the crisis moment. So it's a very good time to rethink some of the fundamentals on what you do with resource revenues. And what are the systematic mistakes? Well, the first one, of course, is not having saved enough. Not having current spending has been too high. So revisiting that, fiscal rules, getting those widely accepted into the culture, into the way the citizenry think about this. Resource revenues are not for immediate current consumption; they're for the present and future generations. So there's getting saving, but also what you do with the saving. Now here the English language isn't very helpful, because when I say saving, I mean accumulating assets, right? Not necessarily financial assets, but accumulating assets. So really thinking, what do we want to do with these resource revenues? And for most developing countries, and I think emerging markets also, it's really growing the domestic economy. So it's really saying, well, we think we're going to be getting some resource revenues coming through. How do we make sensible domestic investment plans? And by investment, I mean accumulating assets, and that could be health, could be education, could be infrastructure, roads. Really thinking that through. And then having fiscal rules that have the high overall savings rate, but are also really geared to productive, efficient use of these resources and these revenues within the domestic economy. I think that's really important to get these messages across, and probably no better time to do it than a moment of near crisis in some countries.
Thank you so much. Mr. Lipton, we have here that some of these countries are really going through a substantial adjustment process. And as you said, they need to prepare, and the smart thing to do is to prepare as this was going to stay for a long time. What the IMF can do, what instruments you could put in place, or you have already in place, that you could deploy to help these countries?
Well, we start with policy advice, and ours in the run-up to this was to build buffers, and so now it is, if you have buffers, you can rely on them to some extent, but then get on, since we do think this will be a durable change, to get on with the adjustments that you'll need to do if this is more permanent. We've advocated that countries allow exchange rate flexibility where that's consistent with their monetary policy regimes, that can help adjust to the fact that balances of payments are, if not permanently, are for some time looking differently. We provide technical assistance and capacity building to try to help countries, if they don't already have what some of the governments of the participants in this panel have, suitable institutional foundations for dealing with situations like this. Budgets that are based on a kind of a permanent income approach to budgeting, having funds or facilities for accumulating savings, and as Anthony said, for allocating those to the kinds of investments that that countries need. Now, obviously, if countries are adversely affected to the point where they have acute financial needs, or if, in the example that I talked about, if there are some exposures that really become quite acute, we have lending facilities that can help countries. Of course, our lending facilities are to help countries over periods of short-term difficulty, but we do have those.
Anthony, one of the key words that we have listened so far in this debate has been diversification. And looking forward, when prices recover and these countries can build again buffers, what is the best way that those buffers can be used to support that diversification? Is in a particular way where saving those reserves, because a lot of these countries, and one of my reportings of recent has been just looking at where those reserves are saved. A lot of this is in savings on Western countries. It's just US treasuries, European debt, corporate debt of highly rated AAA companies, actually not supporting the economies locally. Probably that's a good way to save, but that's not really supporting. So how you see this going forward? Next time that countries can really build the buffers, the diversification is critical to really being able to weather the crisis.
Well, I guess, I mean, to get diversification, I mean, it's easy to list necessary conditions rather than give sufficient ones here. But what do you need? You need the price signals to work. So you need, to have a gain in competitiveness, and obviously the exchange rate is the natural mechanism to bring that about. And you need to be able to have that flexible supply response in your economy. And that requires skilled labour that's perhaps been released from working in government during the good times. It means the infrastructure, the capital, the ports, the cities. It means all that. So for diversification, yeah, the price signals have to be there and have to last. The supply response.
The incredibly sharp drop in oil prices since the second half of 2014 has taken many analysts by surprise, especially considering the scale and swiftness in the decline. As discussed in the IMF and World Bank seminar debate, the severe and swift decline in oil and other commodity prices has had varying impacts and extensive implications for oil importers, exporters, consumers, and governments. The highly variable effects of the oil price drop have created some winners and losers. Some economies that have been hit the hardest appear to be some of the biggest oil exporters, such as Russia and OPEC countries, which are heavily reliant on oil revenues to fund their government expenditures, including social programs and transfers. At the industry level, energy mining companies and affiliated industries have also been very adversely impacted. Even so, many fuel importing countries such as Japan, China, and India have experienced significant cost savings as a result of much lower import bills, causing households to feel a sense of improvement in what their disposable incomes can buy. In addition, businesses, especially those in the export sector, in these countries have gained more traction in their competitiveness. More broadly speaking, lower oil prices will feed into already softening global inflationary pressures, allowing more scope to keep policy settings accommodative, ensuring any recovery in activity to gain even more traction. Therefore, sustained low oil prices are expected to provide a boost to global activity in the medium term. However, for commodity exporters, the warning can't be any louder. Ensure your communities are economically stronger so you can diversify your economy. And quickly, please. I'm Magnus Kpakol, and that's my view.
Magnus,